the Moneyweb Crypto Podcast, where we discuss all things crypto related. Your host, Kieran Ryan.
Bitcoin's extraordinary run over the last 16 months, it's up 320% in rands over that period, has brought a new wave of adopters. While many see it as an asset class in its own right, others see it as a form of sound money that encourages saving and discourages speculation. The thinking goes like this: why invest in the stock market if the currency you are using is continually debased by inflation? You would have done 6 times better putting your savings into Bitcoin rather than the JSE over the last 5 years. One of the more interesting developments over the last year is the traditional financial sector warming to Bitcoin. We see that with the volume of funds being directed into Bitcoin exchange-traded funds by the world's largest investors such as BlackRock and Fidelity. Banks are also warming to crypto. Slowly, for sure, but the hostility of just 5 or 6 years ago appears to be evaporating. And then you have Xapo Bank, the world's first Bitcoin bank. It's been around 10 years. Unlike traditional banks, which hold fiat reserves at the central bank, Xapo holds its reserves in Bitcoin, and more than 29,000 of them. We are clearly entering a new age where traditional banks are being challenged by upstarts like Xapo. We're joined now by Joey Garcia, Chief Legal and Regulatory Officer at Xapo Private Bank, which is based in Gibraltar. He's also a specialist consultant to the United Nations on crypto regulation. Welcome, Joey. It's good to talk to you again. We typically see an increase in adoption rates during Bitcoin bull markets. Are you seeing the same in terms of customer signups at Xapo Bank, people getting a little bit more interested in the idea of a Bitcoin bank?
Thanks for having me, and that's a good question. I mean, I'll say a few things. Historically, go back 10 years. We've been around since 2013, obviously the largest Bitcoin custodian in the world for some time as well. In 2013, if you had $100 exposure to BTC, you weren't really super fussed as to where you held that. When the price increased and it was worth $1,000 or $5,000, you could maybe a little bit more conscious. And, it gets to 10 and 20 and 30, and now we're in the $60,000 mark. Suddenly losing that sort of whatever private key style custodial solution becomes a little bit more concerning. There's no issue in having, $10 in your wallet, but having $50,000 or $60,000 in your wallet is not a great idea. And I'd say the same sort of happens in the Bitcoin context. People are much more conscious around the security arrangements of where they store and hold assets. So again, go back however many years you like. Typically, what's your entry point to the virtual asset ecosystem or to the Bitcoin market? It will have been through an exchange, through typically an unregulated style platform. But even if they're regulated, not many people do sort of, deep dive due diligence on a website that they use to interact with an exchange. They don't typically know where it is. They don't really know how it's regulated. And then you have, some of the big classic sort of catastrophic style events. So the FTX scenarios are probably the easiest to refer to. That was a regulated exchange platform. And I'm only saying that because what we're actually seeing is lots of people who historically stored BTC on an exchange are getting a little bit more nervous or a little bit more conscious of why they're doing that. I mean, to be brutally honest, most exchanges are not really regulated custodians. So you can hold your assets on many different platforms, and many different financial instruments give you different style custodial solutions. If you hold those assets on a platform that isn't really regulated to provide that service, you should definitely be thinking about it. That's where Xapo's completely different. We're a fully and properly regulated entry point to the market in relation to how you hold and own and store BTC. Plus, we're directly linked to a bank. So we are the bank. When you sell BTC and you credit your account, you're holding that on your bank account. You're not holding it on an exchange account. What does that mean? Maybe some people don't fully understand the difference between holding, $60,000 on a bank account versus holding it on an exchange, but they're very, very significant differences. So I'd call it a kind of flight to safety and a flight to security. And, I think people are learning more and more about the ecosystem, more and more about risks, and they want that. People want to hold their assets securely and properly. And I mean, I'm obviously a big proponent, as you know, of regulation and regulatory standards and creating the right ecosystems to provide entry and secure access points to these markets. And I think that's becoming much more and more important and much more and more obvious. So I think we're very much leading the way, if I can say that. And I'll say one other thing, because we're talking about exchanges. In the crypto market, you've seen, and this is, there's public information, the reports in the Financial Times and various other platforms directly, actually, I mean, Binance.com, largest exchange in the world, no question. They publish their own sort of blog around bowing to pressure from customers who wanted to hold their assets with independent custodians, effectively banks. Every big exchange, they're looking for solutions to provide that security of a customer holding their assets on a custodian account, or let's call it a bank account. But they're only really doing that for institutional customers or institutional markets. So I'm a large fund or I'm a significant corporate and I'm not holding $50 million on an exchange account, and they're looking to that. What we do is completely different. We're offering that to the man off the street, the individual who himself wants to hold his assets securely, but in a way, in their bank account, in a secure way, but in a way that allows them to interact with the ecosystem. And that's a very, very significant difference, and completely different to what you see in I'll call it the classic banking world. Lots of interesting developments.
We spoke a year ago, and one of the things that was pretty alarming a year ago was a fact that you actually brought to my attention. 54 exchanges, crypto exchanges, had shut down. And there's clearly security vulnerabilities there. When you put that in that context, that number of exchanges going down or going bust or getting hacked or whatever, it is alarming. So I want to come back to this thing about security in a minute, but just to frame the picture a little bit better, you're the first Bitcoin bank. Are there others on the horizon, or do you foresee a time when you're going to get other Bitcoin banks? And then maybe just define, how do you compare with a traditional bank? I know that you issue a debit card, so presumably people who have Bitcoin on deposit with you, they go out and they can spend that Bitcoin. That completely changes the view of a lot of people. They look at Bitcoin as an asset that you speculate on. But of course, a lot of customers are not looking at it that way. They see it as a form of money, the same way you would have dollars or pounds or euros in your bank account.
Yeah, I mean, lots of things to cover there. I mean, the way that we're set up, it's one application that allows you to interact directly with your bank account and directly with your VASP, your virtual asset service provider account, which is the Bitcoin custodian. So it's two separate legal entities you interact with through one direct application. So the key is the crossover. So for example, if you have a classic bank account and you want to develop a SWIFT or an ACH US dollar payment rail, that goes through the relevant correspondent networks, be SEPA within the European region or FPS or faster payment system for the UK. So all of that's perfect. We add layers. So we have blockchain-based integrated payment rails to your bank account. So we are, US dollar bank account, secure, deposit guarantee scheme insured, you're paying 4.6%, classic bank, but you can send out a transaction into a stablecoin. So new payment rail. And in answer to your question, where are we versus lots of other banks, etc.? I mean, what I'd say is that generally speaking, large institutions are slow adopters of new technologies. And that's not specific to the banking sector. We can go into any sector that you want to refer to. So think about the music. So in the olden days, you had the Napsters and you had the Pirate Bays and you had all these illicit sort of transformational file sharing systems. And everyone was like, this is all crazy and this is all illegal. Now you have Spotify, now you have Apple Music, now you have Tidal, and they're using the same file sharing style infrastructure, a new technology, to provide properly regulated service to the world. The olden guys still making CDs are dead in the water. In the banking context, you had first ATMs, a hole in the wall that you put your card into to extract money. Loads of people oppose that. Loads of the banks and classic infrastructure providers oppose that. Then you had internet banking. That was also fiercely opposed by lots of banks who did not think it was reasonable to allow a computer system to gain access to your bank account. These are all legacy things. And it happens, I mean, honestly, any technology. I mean, we're speaking now over digital comms lines. You're in South Africa. I'm based in Gibraltar. When voice over IP or VoIP systems were developed with Skype, everyone thought it was ludicrous. None of the GSM or classic telecoms providers were like racing to VoIP systems. They all thought it was crazy, but here we are. And in the Bitcoin ecosystem, you can refer to it in many different ways: digital, immutable, digital form of gold. You can talk about it, many of its applications and use cases, and it's completely unique in what it does. Do all banks race to provide direct Bitcoin exposure and access to open and immutable payment system and storage of value? No, they don't. Will they get there? Well, from the last time we spoke to where we spoke today, as you mentioned, you have some of the ETFs going live. You have people wanting to gain exposure to that market indirectly, but others wanting to gain exposure directly. So I see ourselves as like very, very much leading the way. And I can give you lots of examples. I'm not sure what the conversations are like in South Africa around, central bank issued digital currencies or CBDCs. But, people forget, if the Federal Reserve issue a digital dollar or the Bank of England issue a digital pound, that all sounds fantastic. That is blockchain-based payments infrastructure. So if they do that, you're going to have banks, and Barclays and JPM, Chase, and all of these guys are going to have to adapt to new technologies. So I see us as sort of already facilitating stablecoin payment rails and offering exposure to a unit of BTC as, just way, way ahead of what I expect will eventually happen. So that's where I see us in that context.
Just talk about the stable coins. You do offer custody for Bitcoin and I think for a few stable coins. What stable coins do you offer? And for people who don't know what a stable coin is, that is a digital version of a dollar or a euro. It's backed by hard assets, right?
Yeah, exactly. So we don't offer custody of the stablecoin. For us, the stablecoin is literally the payment rail. So we can receive or process a transaction in USDC or USDT. Those are the two largest stablecoins from a USD perspective in the world. You can process a payment into a US dollar bank account and out of a US dollar bank account. So I call that, or refer to it as, the bridge between the two worlds. So you have a classic financial services infrastructure, a bank account, and you have, let's just call it, the wider Web3 universe that operates on blockchain networks. That is the payment rail in and out of that space. So in my view, or in our view, if you want to gain access to an exchange or a high risk lending platform or some staking based mechanism, whatever you'd like to take your own risk on, that's up to you. So you can send money from your bank account into that world. And if you're doing okay, or actually you're thinking about paying a mortgage, or you're thinking about buying a flight, or whatever it might be, you don't really want exposure to that kind of risk. And again, we're the payment rail out of that world into the classic banking, the security. And our banking, again, I think you asked the question before, what makes us different? We are the access points to, let's call it, the Web3 or virtual asset space. Go into that world, take the risks that you choose to take. We're an exit point from that world to a classic secure bank account. So our bank has no borrowing, no lending. There's no concept of fractional reserve banking. It's a new, let's call it, narrow banking model. Very, very simple, very, very secure. And we offer exposure to a different kind of asset class, which is, as you know, Bitcoin. And, from our point of view, I don't think, nobody thinks, I certainly don't propose people put all of their assets and savings into Bitcoin. The message that we've been pitching since 2013 is that, look, you should have probably no less than 1%. It's obviously completely up to you. Maybe not more than 3%. Go absolutely crazy and put 5% and gain exposure to that market. If things don't work out, or there's massive volatility, or whatever you might be concerned around, it's not good. It's not good for anyone to lose 1 or 3% of their savings, but it shouldn't be something that affects your life. But if you do want to gain exposure to that, you have to do it in the right way, in the right, secure and appropriate way. And, the analogy I often use, Karen, if I want to go and visit you in Cape Town, I would absolutely not get on a plane with a 21-year-old driver who didn't even have a pilot's license. So I just simply wouldn't do that. And even less would I put my family on that plane to go and explore new ways of traveling from London to Cape Town. So why, if you are gaining exposure to an asset, why would you do it within a structure where there are no proper governance controls? People don't really know how to manage that business. It's not really operating to the right standard. They don't really understand the concept of a segregation of assets in the right way. There are no proper controls. So that is, unfortunately, the unregulated space, the unregulated crypto space. And, again, FTX, I could give you countless examples, but that's a very good one. They cite in their own insolvency filings the complete lack of governance controls or infrastructure to support the business that they were building. And so the pilot analogy is a funny and good one. That's how people should think about the virtual asset ecosystem. I'm interested. I may want to gain some form of exposure to this and learn a bit, but I only want to do it in the right way. And that's what we are. We're the big Boeing with a massive flight of qualified pilots. Look at our board, look at the structure that we operate under, look at the security, look at our capital. And that's the way that I would think about ourselves.
Yeah, we're running out of time. I wanted to ask you quickly about the security. I think you raised an interesting point there about you're not doing fractional reserve lending. Your reserves are in Bitcoin itself. So I presume you don't offer credit. So that's one of the things that would differentiate you from a bank. So you're kind of a deposit bank. You deposit your Bitcoin and you can withdraw it. Then the question becomes, how secure is that? Now, you've already laid out some of the problems that have been exposed with groups like FTX, not so much FTX in terms of hacking, but, there are some really wild and famous hacks, that Mt. Gox, Bitfinex, and so on. You can list them off. So how do you solve the security issue?
Just to be super clear, our Bitcoin balance sheet is not the capital of the bank. We have to be capitalized properly. Legally, the bank has to be capitalized under all of our CRD, our Capital Requirements Directive, and regulations standards. We operate to that. Call it the European and UK standard. We are regulated in Gibraltar. We're passported into the UK. So we are effectively operating to the standard of London Bank. So from a capital point of view, forget about Bitcoin completely. I'll tell you, if a normal core equity tier 1 capital ratio for a bank at a minimum is 8% or 8.5%, we operate at 132%. And if a standard liquidity coverage ratio might be, so the LCR at 100%, we operate at around 3,200%. That excludes the BTC. The BTC is an additional layer that sits. I won't go into the detail around the structure of our arrangements, but we have a giant balance sheet. Think of it as like an additional layer of guaranteed security. So we don't rely on our 2.5 billion backing of Bitcoin to capitalize a bank. We have to be capitalized in a normal way. We have that as an additional buffer of security. And security is, really, really fundamental. And again, it's a high level point, but in the classic crypto market, I won't cite any particular platform or let's say exchange, but what tends to happen is people will know an exchange as a website. So xyz.com. The reality is that xyz.com has many, many legal entities, and they operate in multiple jurisdictions, and they operate at completely different standards and levels. So you might take xyz.com as, oh, isn't that the platform that's regulated in France? I'm just making that up. Well, they might be regulated in France, but they might have another entity in an unregulated domicile or jurisdiction that actually processes 80% of the volume. And actually, even if you have xyz.com and you say, well, but aren't they regulated in Canada and the US and Thailand and etc.? The reality is that standards that they provide in terms of security operate within the legal requirements of that country. And those are very, very different. So honestly, I could give you so many breakdowns of well-known brand names where people who are being serviced in jurisdiction A are not being serviced in the same way as someone in jurisdiction B, and they just don't even know. They're not even aware. We're completely different. Again, we have one centralized structure operating to the standards that we expect for absolutely everyone. And, having the right security standards, we were often, this is going back to 2015, we were referred to quite openly as the Fort Knox of Bitcoin. And we've been operating, think about it, in this market since 2013. There's never been one breach, never been one hack, never been any form of loss. That's no joke in that market for that period of time. So it's fundamental. I'd say it should be more of a fundamental consideration for people that want to enter this market. But at the moment, it's not really understood by the average user or consumer. And I would encourage people to look at that, regardless of where they choose to hold their assets.
Fascinating stuff. We're going to leave it there. Joey Garcia, thank you very much for that. What an exposition of the banking sector and how Bitcoin is encroaching on that. And we'll definitely stay in touch with you to see how this develops. Joey, Chief Legal Officer and Regulatory Officer at Zappo.
Thanks for listening to the Moneyweb Crypto Podcast, hosted by Kieran Ryan. To listen to our other podcasts, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates.